Last week when we met, we spent a lot of time on discussing the course description and the intended learning outcomes. I strongly recommend you that you people should have a look at the intended learning outcome of the course. I would even say that you should see, you should try to, if you want to understand what exactly is expected from you in each course, then it's not a bad idea to have a look at the ILOs, we call them ILOs, intended learning outcomes of each course. Believe me, it will help you tremendously in shaping and reshaping your learning process. Because sometimes it happens that you know all the contents and everything, but still you don't get good grades. Maybe you didn't understand the nature of the course. So it's not a bad idea to spend some time and understand what exactly is expected out of you. We talked briefly last week about the rationality. And we also talked a little bit about the risk premium. That, and I was constantly using this adage, this proverb that no pains, no gain. So there is always a price you pay. There are no free lunches in finance. Everything costs you. If you want to have the high returns, if you want to maximize the value of your portfolio, believe me, you have to be tolerant to more risk. But if you want to have a risk-less life or comparatively safer life, then I'm afraid you have to compromise the return as well. Then you have to accept for the low return as well. So it goes in tandem, it goes together. These two things are two sides of the same coin. They go in a very tandem fashion together. Risk, return. You have to shop, you have to choose things for yourself. Okay, so that is why it's very important that whenever you work in the future, I wish you all go in the finance industry and you work for some hedge fund. Well, and if you have a client who comes, who says, I have 1 million euros to invest, always try to know your client first. Yeah, so even in finance, knowing your client's behavior, his or her attitude. So all the things which you study in marketing, for example, you can apply in finance. What type of market, which market is growing? What is the wishes of your client? What does he or she wants? So you need to meet your would-be client extensively, try to develop your personal rapport with your client. Only then you can find an ideal portfolio for your investors. Okay, but if you are very proactive and you say, no, don't you worry, I will decide everything for you, then it could be possible that your investors, even though in the end they earn a lot, but they would be very unhappy with the service which you provide to them. So it's very important that you develop some kind of linkage, association with your investors, people who use your investment services. Still, I would stick a little bit with some basic phraseology. Or actually, Shiny said in last meeting that I should not use this classroom whiteboard, but I should rather use the Zoom whiteboard, because then I go away from the computer and then you can't hear me. All right, I can do this way. All I can do is I can resume share, yeah. Stop share, and then I can actually share something else with you. Yeah, the whiteboard. I want to draw your attention to three things. These three pictures, actually. And I want to name them as financing. The first box I want to name as financing. Then my next question to you would be, what you guys mean by the word finance or financing? What do you think finance is? And don't feel shy from giving wrong answers. As I said a couple of times, you rather give wrong answers here than in the exam. What is finance? Yes, sir.
Maybe you write distribution of money flows.
Distribution of money?
Yeah, money flows.
Can you elaborate a bit more?
I mean, distribution of money, how it goes, and what direction, what activities should be financed.
Wait a sec, I'll come back to you. But remember, Stefan, he said that where the money goes to, so maybe we relate it later on. Anybody else about finance? What is financing? Yes.
In the market, there are people that have more money that they need, people with less money that need the money to invest in some activities. So they will need the money, and these are like the exchange of money.
I need a lot of money. Can you give me some?
Not me, but some people have more money.
Can you arrange somebody who can give me a lot of money? I'll be very happy.
Me sometimes.
Okay. Yes. Any other thoughts? That's a good point. But I want to take these bits of points, but then I would club them together. Any other point? Any? Yes, Fernanda. Sorry, say again.
Allocation of economic resources.
Allocation of economic resources. That looks like some state actions to distribute resources. Okay. You all are moving around the main point. Or what? Say me something. Say wrong. Who cares? The ladies over here in the middle. Any idea? What is finance? What do you think is finance? Strategies of what?
Because you have goals and you have to elaborate different strategies to reach your goals.
Strategies to what? I missed a little bit.
You have to elaborate strategies to reach your goals.
To reach your goals.
Yeah.
Okay. All right. Well, that can be. But okay, anybody here? The ladies in these middle area. Yes, please go ahead.
Maybe paying, like allocating money to a certain activity so it can be performed, so it can be conducted.
Okay. So you said almost same as one gentleman here said. Yeah. So allocating of money. Yeah. Am I right? Okay. Financing is basically where money comes from, in simple words. Financing is where money comes from. If you are a CFO of a company, top company, or even a startup, your first concern is, hey, folks, you see what? I tell you something, a real life phenomenon. A couple of years ago, a local startup company approached me and they said that, you know what, we have a couple of pitches in the future, but we are so obsessed with the technical ideas, our innovative ideas about the project itself that we are not really aware that how we should ask for the money. We don't even know the value of invention that we have made. It's a great invention, but everybody asks, oh, great invention. How much is the value of this invention? And we don't know the price at what we should sell it. So can you do the valuation of this project? And the second thing, people ask us how much money you need to develop your idea. And we don't know. It could be, sometimes we think, oh, 10,000 euro would be enough. And sometimes we think that even 100,000 euros would be less. So we have no idea. What this company was asking us, that tell them how much money they need to carry on their project, innovation, and how much, where this money should come from. Financing, in one sentence, is where money comes from. Money comes majorly from two sources. Well, we have some hybrid sources, but in principle, the money comes from two sources, and that is debt and equity. Debt and equity. Have you heard these two phrases before? Huh? Have you? Okay. I can do some role play. I can do some role play to explain. There are a few messages in the chat, I guess.
Yes.
Okay. Debt and equity. Can somebody say something? What is debt and what is equity before I explain it? Any ideas about debt and equity? And please don't shy from speaking out. You don't have to.
The equity is like from yourself,
Uh-huh.
and that is from a bank or where you.
That's true. That's
want
true.
to go.
Yeah. Debt plus equity. Let me say this way also, that if I have another equation, I can say that debt plus equity is the total capital. And you can say it in a layman's words that debt is something which is that part of capital which we borrow from banks or some, we always say the word, what's the word actually? There is a friends and fools. So you borrow from others. Yeah, you invest others' money, right? And equity is your own, investment. But in the big companies, where the ownership and control are two different things, I would say that debt and equity are their distinction or the meaning slightly changes. Let me give you an example. Imagine we are a big company, or even we are a startup. Why think about a big company? Come on. And I organize a meeting. I invite all of you, and we are sitting like this, the way you're sitting now. And I ask you, folks, this is my business idea. I give a presentation about, I only talk about my business ideas. And you are thoroughly impressed by my ideas. And then I ask you, since I have only idea, but I have a great mind, but my pockets are empty. Would you like to invest in my company? If you like the idea, then would you be my investors? And then many of you say, yes, we will be investors. Of course, why not? My next question would be, how would you like to invest? Let's say half of you, this side, the right-hand side, people say that, you know what, Shab, we like your idea, but we will give our money as investment, but in the form of debt. Debt means each of you give me some 100 euros, and we agree that I would pay you 5% rate of interest every year. You give me 100 euros, it means at the end of the year, you get 5 euros interest on top. Yeah. And I ask you why you want to invest in the debt. And you say that even though we like your idea, but there is still some risk and we don't want to take too much of risk. We want that we get fixed interest. Your profits can go up or down. There's a risk. So we don't want to take that risk at all. We want a flat rate of interest. And we also want a guarantee that the money which we invest comes back. So you want two assurances from me. The first assurance you want is that you don't want to take the risk of fluctuations in my cash flows. It can go up, it can go down, but you want a fixed rate of interest. And secondly, you want that the 100 euros which each of you agree to give to me, you get it back. And then we have another group of people sitting on my left side. They say, Shab, don't worry. I like your idea. Go ahead. Take 100 euros and make me your shareholder. I am open to risk. Let it be. I'm very confident that this idea would flourish, would be successful. And I know that the cash flows would go up. I don't want 5%. Come on, 5% are peanuts. I want to be the beneficiary of big rate of return. And even if you lose, you lose. Come on, I'm a risk lover. Guess what happens then? A euro is a euro, but the quality of each euro you pay me is different. The 100 euros which each of you pay is a little bit conservative. You like my idea, but you were a little bit cautious in making investment. But on the other hand, these people, this side, they were more maverick, more risk-taking, and they say, we don't like 5%. 5 euros, who will wait for 5 euros for a year? We want big money. But at the same time, you, let alone big money, you can even lose your 100 euros altogether. But they people were very particular. They say, not only we want a fixed rate of interest, but we also want a guarantee that the 100 euros which we give to you comes back. You, in search of big percentage of gain, are prepared to take risk and lose even your initial investment. It means what? I can distinguish you in two categories already. Relatively risk averse people. Let me write this word. I forget, I would write here. Relatively risk averse people, they invest in debt, and relatively risk lover people, they are investing in equity. But remember, those people, risk averse mean they don't like risk. They want to keep it at bay. But remember that for the debt holders, if I say you are my debt holders and you are my equity holders, combined you are my investors. Are you not? But one form of investment is my internal, because now you become my shareholders, do you? So you are part of the company, remember. But these people, even though they are investors, but I use a phrase called arm's length distance between them. Why I keep an arm's length distance between them and myself? Because I'm bound to give them 5 euros for every 100 euros they invest, plus give them their initial investment back. But with you, I don't have any such, how to say, such bonding. Well, I have a bonding, but I don't have any accountability to give. So it means that we have somewhat close association and a distance association. But altogether, this money has a color. One is risky color and the other is less risky color. Okay, so this is called, and where do you show it? Anybody has taken accounting course? Where do you keep your debt and equity money? In which statement you keep it? How many of you have studied accounting before? Where do you keep this money? Debt and equity. Which statement you keep it in? Sorry? Say again? What is that?
Like on the balance, the right side. Yeah, that's what do you call it? I don't know.
On the balance sheet.
In the balance sheet, but which side? Assets or liabilities?
Liabilities.
Liabilities.
Yeah. That's correct.
So you have the assets on one side. Oh, sorry, Shiny. You have the balance sheet of a company, and the balance sheet on the one hand has assets, and on the other hand it has liabilities plus equity capital. So if you recall your management accounting or any accounting course before, you will see that your total assets are equal to liabilities plus equity capital. And here, financing is equal to your liabilities plus equity capital. This is where the money comes from. Yeah. Does it make sense? Are you fine with this? So financing means the money comes from. Now the money comes from, money has come. What would I do now next? What would I do now? I will make investment. So we need to know the meaning, because sometimes the word finance and investment are very much interconnected and we confuse it. Let me text here. This third picture is investing. If financing is where money comes from, what would be investing? Where money goes to. Investing is where money goes to. Okay, I assume that half of you gave me 100 euros in the form of debt. Half of you gave me 100 euros each in the form of equity. Now I have, if I count you, you are almost 50 people. Okay, so 50 times. So I have 5,000 euros now. What do I do next? What I do with this 5,000?
Invest, make more money out of it.
Yeah, I invest this money. So by investment means investing. So that's so investing where money goes to. What I would do with this money? I would start my projects. I would start undertaking projects. If I'm an oil company, I would start buying the new oil rigs, which helps to explore oil. I would take some area for lease where I can't just go in the sea and start getting oil from everywhere. I have to be very careful that this is my territory where I can extract oil. I would start hiring, I would start doing R&D expenditures. I would try to innovate. I would try to even start my subsidiaries abroad. So I have a lot of things to do basically with this money. So basically, if financing is equal to liabilities plus equity capital, then investing is equal to assets. Have you seen assets in the balance sheet? Yeah. Assets represent your investments. Liability and equity capital together represents your financing. So one side of the balance sheet is investing and the other side of the balance sheet is financing. Try to understand. When I took this money from you, either as a debt holder or equity holder, you have a claim on me, isn't it? I mean, you own a claim on me. But when I invest in the assets, then I have a claim on others. So assets, what you own. So I also sometimes say that assets is something which you own, and liability. Liability is something which you owe. Can you see? Look at these two words, own and owe. There's only difference between N and E, last letter, N and E. But that makes a big difference. What you own and what you owe. You start your business by taking a loan from the bank. You owe. With this money you took from the bank, you started your office, furniture, computers, your plant, your R&D and all that stuff, your patents and your copyrights, and you start developing thoughts, your softwares and everything. That's what you own. Okay? Does it make sense? Yeah. The difference between own and owe is your equity capital. If at any stage you owe more than what you own, then your equity capital would become negative and the company becomes bankrupt. Are you with me? Look at the equation. It says assets. Shani, I'm writing it here because this equation is already in Zoom right now. Yeah. Assets is equal to liability plus equity capital. This is what you owe. This is what you own. So as long as what you own is more than what you owe, it means what? It means your equity capital's value is positive. And that's what we want. Every surviving company, every continuing company wants its equity capital to be positive or even more positive in the future. But if what you own is less than what you owe, that's obvious that it's equal to, or even it's equal, then your liability, then your capital would become zero. Come on, who would invest in your company? So therefore, it's very important in the very beginning that we understand the meaning and the difference between the finance and investment. Now, the story is still incomplete. We have a picture in the middle. Can you see? The first box, I can see. The first box is investing. The third box I put for investing. I took one picture. Very less space, but I can do it here actually. Yeah. This is the box, the middle box. This is the operations. Operations. Imagine, I still continue my example. I took money from you in the form of debt. I took money from you in the form of equity. And all together, when I calculate the cost, it comes out that I must pay my investors at least to make them happy, to make them that they stick with me. I must generate at least 7% a year. The average of debt, average of equity, all together, I need 7%. I need 7% cost of capital, yeah, to make you happy. And then I start investing this money in the assets as we discussed. How much return I should produce what should be the minimum return I produce that I continue and my company doesn't become bankrupt. 7% is my cost, minimum cost to keep my investors with me. So what should be if 7% is my return, is my cost of capital, what should be my return of capital? Try to understand my problem. My problem is that I have made a commitment with you that I must give you 7%. Even though you don't demand, but at least I know that if I don't satisfy your wishes, you would leave me at some stage. And I make the calculation that overall, on an average, I need 7% cost for every $100 a euro which I took from you. I need 7% to give you back. Obviously, you guys demand 5% because you take less risk. They demand more than 5% because they take more risk. Do you agree with me? And when I find the average, it comes to be 7%. What next? How much return I should generate from my investment that you guys are happy?
Well, the minimum is 7.
Exactly. More than, I should have more than, well, more the merrier. I should generate, or I must generate more than 7% return so that I'm able to, on my investments, let's say I get 10%, and then I give you back 7%. Guess what happens? 3% is I save. I save. I accumulate my savings. Guess what happens? I become cash rich company. I have more resources. Now what I can do with that, I can pay good salaries to my staff. So all the well-educated MBAs and engineers, they come and join me. I got huge block, collection of minds. I can do innovation. I can make a new product development. I can launch a new product. I can even expand my operations away from Finland. I can open my subsidiaries in Asia. Or I can even divest my business. I can even expand my business. I can even change some of my business lines. Initially, I was an IT company, and now I owned a bank in South America. Why I'm doing it? Where does more than 7% come from? It comes from discipline. It comes from control. It comes from hard work. It comes from less wastage. It comes from more efficiency, more output. And where these measures are seen, more efficiency, less wastage, in this box. And what is the name of this box? Operations. How well? I can have great assets, but guess what happens? Half of the time, they are being wasted. They're not being used. What happens? I had a very horrible HR manager. His planning is so that half of the staff is always having lunch or coffee break, and only half of the people are working in the machine. Resource wasted. I have horrible supervisors. When there's a lunch break, they don't shut off the electricity. The machines keep running. The inputs get wasted. I have the horrible store manager. The previous raw material is not used yet, and he's ordering the fresh ones. I have absolutely indisciplined employees. They don't come at 9 o'clock, they come at 10 and leave at 3. Nobody checks. What I'm talking about it now. I'm talking about the 9 to 5 things now, that what happens during the daytime, what happens during when the factory is working, how you operate, how you function. That is I can be having more than 7%. 8% is more than 7, 9% is, see what, I want to get more and more away from 7% on the higher side. That is only possible if my company's operations are done in a nice way, in a disciplined way. So therefore, you can have the best of, you can be very smart and make people empty their pockets and give you money. And you can be a great strategist and start investing in the wonderful projects. But if you're a bad manager, if you are not very If you don't know how to discipline and run your company on minute-to-minute basis, there's no accountability, no control, no monitoring, then your operations can let you down. Okay? And this exactly is called a firm. So a firm is what? If you see from this financial management side definition of a firm is including 3 pillars: financing, plus investing, plus operations. And it's so visible, actually. Financing, you see where? Where do you see financing? I told you. Where do you see firm financing? In the balance sheet, on the liability plus equity capital side. Where do you see investing? In the balance sheet, on the asset side, yeah? Now, where do you see operations? Huh? Where do you see operations? How well you operate? Where do you see it?
Returns.
You're almost there, but not fully there.
Minus cost.
Where do you see it?
Return minus cost.
In which income statement? Said already. I should have said in which statement. I said in which income statement. Yes, you see it in the income statement. Remember, you have two very important financial statements. One is the balance sheet, which on the one hand assets, and then the other side you have the liabilities plus capital. But you also have one more very important statement called income statement. And in the income statement, what do you see? You see that you make a sales, you sell your products minus your cost. Okay, and larger are your sales, and the lower is your cost, more profits you generate. Yeah. Out of some profits you give to your shareholders, it's called dividend. Yeah. Some profit you give in the form of taxes, but some profit you always keep with yourself because you want to grow in the future. Okay, there are some good reasons to keep some profits with you because you want to expand in the future, but sometimes you also have a bad reason to keep some profits with you because in case there is any financial emergency in the future, let's say suddenly your customers stop buying from you, or suddenly there is a change of technology and you have the risk of running out of business, then you can use those saved money to keep yourself going. Yeah. So remember, when we talk about the financing and investing, never undermine the importance of companies' operations. Okay. I hope many of you, is anyone in the class who never studied any accounting course? Is anybody who never studied any accounting course? So you all are familiar with the income statement, yeah? So the profits which you see in the income statement is basically a reflection of how well you operate. And then you go to the balance sheet and you see the income statement, the assets and the liability side. So this is how it goes. Yeah. Questions, comments so far? Any ideas or anything which you haven't understood? You have to say anything, Stefan? I missed out anything? Let me share my slides once again. Okay. And by the way, one thing I want to discuss with you more is that the firm's financing, remember the example that I took some debt and capital equity, yeah? we use a phrase called financial structure or capital structure. So how many are you on this side? Let me count, because I want to give you exact example. So you're 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So if I take debt, it will be 1,700. Shiny, I just counted people on one side who are willing to give me debt, and they are 17. So if I multiply each by 100 euros, it comes to be 1,700, right? So this is the debt, okay? And let me see how many are going to invest in the equity capital. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 21, 2. 22 people who are going to invest in my company. So 2,200. It means that when I finish my lecture, I would be having 3,900 euros in my pocket. Stefan, can you already start collecting the money from me? So we have 2,200. So if you divide 1,700 by 2,200, I guess it comes to be approximately 0.84, let's say. Yeah, 0.84. Huh?
0.77.
How much?
0.77.
77? Okay, you are very exact. So Yvonne has spotted my error, and I confess it. 0.77. It means my capital structure is that for every €1 of equity, I have 77 cents of debt. Am I right? Okay. This is an indicator of my capital structure. So it means that for every €1 of equity, I have 77 cents of debt. So I'm more equity financed than debt financed. Am I right? But imagine that in my business over time, the debt is increasing. So this year it's 0.77. Yeah. Next year it goes to, let's say, 85, and then it goes to 1.23. So the percentage of debt for the given equity is increasing over time. 0.77, then it becomes 0.85, then it becomes 1.23. How would you, as a business analyst, if you all are recruited by some financial company, some hedge fund, and I'm your trainer, and you are my trainee fund managers, and you see that for the same company, this ratio D to E, debt to equity, was 0.77 in 1 year. Next year it goes to 0.85. Next year it goes to 1.23. How would you view it? How would you reflect on it? Think about it. This year, now, I took 1,700 in the form of debt, 2,200 in the form of equity. I divide D to E, I get 0.77. But imagine next year, in the future, this ratio becomes higher and higher, so much so that your D to E becomes more than 1.23. How would you reflect as a business analyst? We have a lady there, then I come back to you. Yes, go ahead. Sorry?
It's bankruptcy. No more than you own.
Is it bankruptcy?
No.
Remember, this 1,700, try to understand, this 1,700 and 2,200 are on the one side of the equation. So 1,700 plus 2,200, don't find their subtraction. you add them. It means your total assets are 3,900. See, what is the equation? The equation is assets. So you are only finding the ratio of these two things. You're not touching this side. So therefore, there's no bankruptcy. Do you get my point? Yeah. I'm not saying that your assets are this much. If your assets fall short of your liabilities, then your equity is negative. But I'm not going this side of the equation. I'm only just debating this and this between one another. So therefore, there's no bankruptcy. Well, there can be bankruptcy. I'll explain it to you a bit later. Yes, Yanni?
I would be worried, but I would be asking that why is your debt raising so much? Are you running some kind of operations that you need the funding for a moment? What kind of future plans do you have to
exactly? Yeah. Even though on the face value, apparently it's worrying. Come on, your debt is increasing. See, try to understand. I come back to the same example when I ask you to give me debt and equity. See my situation. I feel more freehand, more independent when I have more equity investors than my debt investors. You know why? Because with you guys, I promised that I would pay you 5%. Okay. At the same time, I would give your investment back. So, because you were risk averse. But with these people, story was different. They took their own risk. They joined me at their own risk. So therefore, I'm a little bit relaxed with the equity than debt. So therefore, apparently, if the debt is increasing, I, as a CEO, is a bit worrying because now my fixed payments are going up. Listen. And because my fixed payments are going up, try to understand my situation. See the realistic situation. Let's say I have some X amount of money with me. With this X amount of investment, I can undertake a marvelous project, fantastic project, which would really make my cash flows up in the future. But then there is a deadline coming. I have to pay you back. Come on, you'll be after my life if I don't pay you 5% rate of interest. So what happens? I have to give up sorrowfully, tears in my eyes. I have to give up a project just because I have to pay you. Come on, they people will not worry about it. So it means that my entrepreneurial independence is shrinking if my debt is increasing in comparison to equity. Yeah. On the other hand, the good news of debt is that it makes the managers disciplined. If I have less debt and more equity, you know what? I can take things for granted. I can have this, what is this phenomenon? I can suffer from managerial slackness. Managerial slackness is that when you become lazy, basically. You take things for granted. And the empirical evidence shows that the good companies take a bad decision, not in the bad times, but in the good times. The bad times actually come as an outcome of the bad decisions taken during the good times. So when I have less debt, I can think myself as I can think like a corporate emperor. I don't have any immediate accountability to anybody. But if I have more debt, it keeps me on toes. That, hey, minimum 7% I have to generate, 5%, whatever, to pay you back. So some discipline, some whip is always on my head. And this is a very important point in corporate governance as well, not only in finance, but also in corporate governance. Then we need to look for what is the ideal ratio of debt to equity, that you as a CEO neither lose your independence nor you become lazy, skiver. Believe me, skiver is not a bad word. Huh? I'm not saying equal. I'm not saying it equal. It doesn't have to be 0. It doesn't have to be 1. No. I'm not saying it. I'm saying that for each company, this ratio, this coefficient of debt divided by equity is different. Okay, I want to ask you, which industry or sectors you think that even if we have higher D to E ratio, it's not to worry too much. And at the same time, so for example, if 0.85 is in certain industry, you think it's nothing to worry. But then you also give me some example where you find that, hey, this 0.85 can be dangerous. You get my point? So it could be possible that high D to E ratio is perfectly okay for certain type of industries, but the higher D to E ratio can be alarming, at least. It's a word of caution to you in some industries and sectors. Please tell me. And my friends who are in Zoom, I hope you understand the question that can you give some opinion about higher D to E ratio, which you consider is risky? In which companies, in which industries you consider it risky? And in which industries or sectors a higher D to E ratio is not so dangerous? And I give you 5 minutes to think about it. And please come up with your, not only give me some example, but also give me the reasoning why you think so. Any thoughts? Any thoughts that why a certain D to E ratio seems to be okay for some industry or sector, whereas it can be alarming for the other industry or sector? Why do you think so? And please, yes, lady over here. Sorry, say again. In the bank sector, what is what?
It's not alarming because it's quite, they have felt that it's normal to get that.
Yeah, it's normal to get that here.
And because it's quite the opposite than you have in all other companies.
Yeah. But I would say that for the banks, you have to be careful when you make such judgment, because in the banks, borrowing and lending is part of your operations. So you're mixing operations in investing and financing. So you be very careful. But it's very important. You said that about banking. See, I do a lot of empirical research. Yeah, and whenever I do the research of some corporate finance topic, I never take banks in my sample. I never take banks because banks are different animals, because their financing is not just financing, it's also the part of the operations. So you have to be, but you're right that for the banks, it may not be so alarming because it's a part of the business. Yeah, but the judgment, the conclusion which you draw about the banks are very dangerous if you mix it with the other banks, with the non-banks. Okay, so if you say that, hey, bank, if you compare the D to E ratio of a bank with some pharmaceutical company or an oil company, it can be risky comparison. Yeah, because for a pharmaceutical company, D and E are not part of their operations. They sell medicines, whereas the bank sells loan. So to be careful. Yeah, any other point? Yes, gentleman at the back. An oil company, if the D to E ratio goes up, is it risky or not risky? They can still run. Can you give me the reasoning for it? Very good, very good. So I write down the yes and no type of. So you know what I mean? That where high D to E ratio is okay and where high D to E ratio is not okay. The first example, Shiny, one good example is that if in the oil sector, your D to E ratio is higher, it's not a big worry. Okay, any other example where D to E ratio can go up without much problem? So for the airline industry,
Yeah, that's really risky for them. No, that's not the case for them.
is not okay.
No, it's alarming for production.
So they should have low D to E ratio.
Yeah, if they have a lot of them. Yeah.
Okay.
Because that's not so profitable industries, and there are a lot of expenses.
But there are a lot of expenses in the oil industry also. Oil industries.
Industry, there's a huge demand.
But there's a huge demand in the airline industry also. No, but look at the airline industry. It's huge demand. People are traveling. I mean, but apart from this COVID thing.
Our production is really complicated.
Okay. Can I ask this gentleman again who said the oil industry is a good example? Do you think airline and the oil industry is a good borrower or bad borrowers? You said that the oil industry is a good borrower. Will you also include airline into it? Yeah, I mean, is it okay if the D to E ratio is higher in the airline industry and it's not a big problem? So we have two opposite views. In the one case, we see that the gentleman over here, he said that for the airline, the D to E ratio should be low. Whereas the other gentleman says that, no, I think the oil and airline industry are good borrowers, so the D to E ratio can go up. Interesting. What do you think? Anybody else? Any opinion about it? Yes. How, what?
Small airline. Then it's more problematic than when it's.
But see what? There can be small oil company also. When we say oil company, we only look at BP, Total, Shell, but there are some small oil companies as well. Yeah. Okay. Now, if I can contribute in the discussion, one very important factor, and actually I should draw this picture here because otherwise Shiny would be very angry with me. I make a list of, should I have a new, how do I have the new thing? It's here, yeah. So if I draw the text, yeah. To me, to be a good borrower, and please, both gentlemen, have a look at this point. The one factor which can help you to borrow more or less depends on tangibility / So tangibility, good borrower. Intangibility, bad borrower. And tangibility and intangibility of what? Of assets. If there's a company or industry or sector where most of your assets are tangible, physical, see what? Building, aircrafts, oil rigs, haulage, the vehicles which carry all the oil stuff. And you also have some lower end operations, like you have the gas stations also. Do you see something? Sounding? Well, if at all there's a major crisis on the company, these assets can be used as a collateral. I use this word collateral. I don't know whether you understand it. Collateral. Collateral is if you want to borrow from the bank, you have to give some security to the bank before you borrow. But so these assets, the building, property, all that stuff, you can give the papers and you can borrow. Yeah, no problem. Or even in the more crisis, if the company is almost close to bankruptcy, you can sell these assets. Somebody would buy them and you can survive. On the other hand, if your company main assets are intangible, non-physical, intellectual capital type of assets, it's risky to sell. Imagine you go to a bank, you go to Nordea in city center and go meet the bank manager and ask, I need 1 million euros and I have a business plan. And they say, what kind of assets you have to collateral? And you say, I have developed this formula, please keep it and give me 1 billion euros. They would laugh, isn't it? Do you get my point? But if you have the building, property and all that stuff and you give them some documents, and then they feel more secure in lending you, isn't? So that if you are a company with huge percentage of intangible assets, then your higher D to E ratio can be risky and alarming. Can you name some industry where most of the assets of the companies are in the form of intangible assets?
My services like delivery.
All the services. Look at the consultancy companies.
No, like yeah. Also, but also like the meal delivery companies or something.
Which one?
Like Uber.
Oh yes, look at this Uber. All this. That's just a service. Franchise, for example. Some more examples. IT sector. You develop the formula or some kind of software. Yes, sir. Yeah. Yes. Or the media company. Or you are a R&D firm. Or even you are some kind of biotech sort of companies. Most of the assets you have are the minds, but not the physical capital. You have more of non-physical / intellectual capital, but you don't have the physical capital to, you never go to a bank and say that, hey, can I borrow against my highly skillful employee? He got marvelous mind. Can I borrow against him? That's what would they do? They can keep Stefan with them, but that would make the modern day slavery, which you don't allow. Yeah, Stefan, I don't think you like to be in the bank 24/7. Okay, the second point which make you good or bad borrower is what? And I know you discussed it. You talk to me. Yeah, profitability, efficiency. So if a company has a consistent, stable, I'm not saying huge profits in 1 year and next year nosedive. No zigzag. Even if the profits are not huge, massive, but they are stable, consistent. So if you are a company with the stable but good profits, you are a good borrower. So even if your D to E ratio goes up, hell will not break loose. Don't worry too much. Come on. You got a lot of profits. So if a company's profitability is, and why, on what factor your profitability depends on? Good operations. And I said that you've been doing it consistently. Well, you are making the products or the services which are in demand. If you were not producing the goods and services which are not in demand or were not in demand, then how could you earn the profit in the first place? Higher profits is an indication that you are feeling the pulse of the market. You know what people want, and then you sell it. Yeah. So more profit, not more profit, but reliable, consistent, stable profitability is a good yardstick to. So if you're a company, even having high profits, but 1 year, but bad year, next year is very bad. No, you're not a good borrower. And if you have very low profits, absolutely, then again, you're not a good borrower. So you not only have good profits, but also stable profits. You are a good borrower. Any other point which makes you, when I say good borrower, it means you can afford to have higher D to E ratio. And when I say bad borrower, it means that you should keep your D to E ratio under control, not too much. Any other factor which governs good or bad borrowings? Any thoughts? How about the company's history, historic track record of performance? Of good performance, so that I can put plus sign here. Good performance, so I can put a plus sign here. A company has been doing great performance historically. The company is old, it has a legacy, it has a history. If you look at the major corporate houses, if they go to a bank, imagine a scenario. The CFO of GM, General Motors, is visiting the bank manager. At the same time, there is a manager of a startup coming to him, and they are demanding loan. Who bank manager would be more happy to give loan to? Huh? GM. Why so?
They have the track record.
They have a track record. This company is nearly 100-year-old. And the fact that this company has seen different seasons over time, bad weathers, good times, horrible times, very bad situation. It could have been many occasions when the company could have been declared bankrupt. The company survived. Larger, longer is the historic span of a company. It is a vindication of the fact that the company has more survival instinct. And then comes a startup, no track record, very limited track record. So in that case, the obvious choice of, if a startup is highly debt finance, it's worrying. But if a company who has stable growth, good profits, a very promising history, career, it's fine. Any other point which makes distinguish between good borrower and the bad borrower? Yeah, very good. So your growth potentials. Now imagine the same situation. There are two CEOs. They are entering the bank manager's office. The one is CEO of a health company. They make some equipment or some kits to protect against COVID or any other contagious disease. And the second CEO is a CEO of a mining company, coal mining company. And the other thing is fine, same history, equal history, everything is good. But the only difference is that the one is a CEO of a health equipment, and the other is a CEO of a coal mining company. Who would get better treatment? And why? Why so?
Because mining in the future will no longer be.
As a matter of fact, I was talking to a friend of mine. He's a manager in Nordea, and he said that they have decided many years ago not to give loans to any mining company already. And if they gave, it's very restricted, very restricted. Yeah. And the other example I chose on purpose without any evidence, but I believe that the health sector is a very promising sector for the private sector. You know, the private companies which will be investing in the health sector and the education sector, they have a very, very promising future. So the growth potential is more. Yeah. So higher growth potential. And I put a positive sign here. Any other point you think? I have at least one point in my mind. I would say that if you are a company with low operating costs, then you are a good borrower. Agree with me or disagree with me? Your fixed costs are less, and you have a lower operating cost. You can be considered to be a good borrower. How many of you live in COAS building, the student apartments in Uvasvilla? Not in the private sector, but those, in Kortepohja or is it Kortepohja? No, it's Muliyarvi and some other parts. Yeah. If the owner of this housing company goes to a bank, will he get or she get better treatment or not so better treatment? Mm-hmm. Good. Why so?
Maybe cost fluctuations are not so big.
Very good. Very good. I totally agree with you. You may think differently, but I think that if the owner of this housing company goes to borrow, he's a good borrower. Why so? First of all these buildings are tangible assets. So it's collateral, you can use as a collateral. Secondly, they own building, right? But in the building, there are human beings living. They are not burden on the company. They are rather giving cash inflow for the company. You are paying rent, come on. Now imagine it's not a housing company, but it's some other company. And you are not the money givers, but you are the employees of the company. Then the company would pay you salary, isn't it? See the situation. Just imagine that it's any other business operation office. Then the company would be paying salary to you because you're doing something, some job for the company. Now what you do now, almost same people in that building, but now you are paying money to the company. And look at the cost. They have some janitors and some other people, but I think 1 or 2 janitors are enough to manage entire Muliyarvi and what's the name of this company? Poronimäki and stuff here. Look, One person is enough to take care of it. And then not only that, the cash flows are very stable because you always pay in time. You miss the deadline and see how they react. So the cash flow is very stable. If they were oil company, they might have to wait for 2, 3, 4 years before the cash flow comes. So the cash flow is so stable, instant. Stable cash flow, demand, because Uvascula is always has been a student city, except for 1 year when there was COVID, and now people are coming here, and the demand would always go up. So it's a good growth potential, tangible assets, low operating cost. So this housing company fulfills almost all the good parameters to be a good borrower, isn't? Yeah, we have a point here. Yeah, what is that?
Maybe managerial efficiency. Staff training.
Yeah, but managerial efficiencies reflect on your operating cost.
Yeah.
So that way, if you're a good manager, then your operating cost will go down anyways. Yeah. Okay. All right. Well, I think if any other point my online friends want to give. Great.
Shah,
go ahead.
the automobile industry is a good borrower.
On what parameter?
Like for an example, Volkswagen.
No. I'm saying is that we have 5 points here: 1, 2, 3, 4, 5. I hope you can see.
Yeah. Yeah.
So Volkswagen
tangible,
fits into which point?
They have tangible products, assets,
yeah.
And they are stable, and they have a historic track records.
Yeah.
And they are high growth potential also in future.
Sort of, yeah.
So I think because of that.
Yeah, that's true. Yeah, I agree with you. In the automobile sector, there is no clear unanimity about the growth potentials, because we are heading towards the hybrid are already there, and the fully electric cars are already there. So how well each company is prepared for the future of automobile industry. In fact, I was reading an article a couple of days ago, and the article title says that it's not a good time to buy a car because the automobile industry is going through very kind of innovative phase. So maybe you end up paying more price if you buy a car now. Okay, so that's everything for today. And in nutshell, I didn't go through many slides today on purpose, because I want that the fundamentals of our discussion should be strong enough so that we can go at the higher level. So if I sum up today's session, it was more about financing, investing, and operations. And we also discussed on what parameters, what are the key criteria of higher debt or lower debt for a company. Okay, so by the end of the day, I would be having this recording and I would be sharing it with you. Okay, so good luck, have a good time, and see you next week. Okay, folks, now I close the meeting. If you don't have any point, then I close it down. All right, so take care of yourself and see you soon.
Bye.
Bye-bye. It doesn't go. Where it goes now.